Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. This is the start of a two-part series I recorded last week, 2 parts for us with a guest that I have with us, Ian George, who's a specialist in insurance. And we recorded both shows last week. You could tell I still have my voice issues here. And what we're doing is continuing a conversation on how to protect and how every family member can protect their dependents if we have something unforeseen prematurely happen to us that discontinues our ability to provide for our family. That's premature death, premature disability, long-term care, something like that, that we did not count on. And one of the processes we do as financial planners, what we are doing is there a way to design in our financial plan a way to self-complete our future goals should anything prematurely interrupt our ability for continuation of earning income and providing for our families. So Ian, I welcome you again and thank you for coming on the show.
My pleasure.
Last week we talked a little bit about how to calculate a base amount that insurance that a family might need for life insurance to replace income from a lost income producer from someone who had died prematurely. So, Ian, I want to continue that conversation if we can with other things you'd like to share here.
Sure. So we did talk last week about the most common way that people want to work with and calculate a life insurance amount that's appropriate for them. The next question that often comes up with a lot of individuals is, what type of life insurance should I have? There are so many different types and names of life insurance and things that go on that it gets very confusing for a lot of individuals. And as an industry, we've done a horrible job of making that simple and easy to understand. So what I find is helpful for individuals and families and couples to have an idea about is that what types of life insurance exist, how they work, and how they can be effective for them as individuals and for their families. So what's the appropriate type, if you will? We talked about appropriate amount, one way of talking about appropriate amount.
Right.
But what are the types of life insurance? Now here's the good news. The good news is, despite all the different spins and names that everything's been given, there are really only 3 types of life insurance.
Okay.
Yep. So the first type of life insurance is the easiest type of life insurance for everybody to understand. It's term life insurance. Term life insurance is a straightforward deal. It's basically considered pure risk insurance, to which it almost is. Insurance companies don't issue anything for free. So there's some fees that go on, and so it's not completely pure risk, but it's basically pure risk life insurance.
Okay.
And what that basically means is that an amount is derived, and what they're going to do is, based on your age and your health, figure out what the odds are. So if somebody wants, $1 million of life insurance, it's going to be more expensive for somebody who's 50 versus somebody who's 20. Mm-hmm. Because the odds of the 20-year-old dying are much lower than the odds of the 50-year-old dying. And that's translated directly in term life insurance premiums. Term life insurance premiums, generally speaking, follow mortality charges. So in my example, we had a 20-year-old paying less than a 50-year-old. But over time, the mortality charge, which is what the cost for the insurance is going to go up and up and up and up and up. And a lot of times I'll use an extreme example, which is if you were 100 years old and wanted $1 million of life insurance, the premium would be, $1,005,000. Because they need to make a little bit of money on that transaction. So That's the, that term life insurance is the simplest. And very often what you'll find is that people are buying it with guaranteed premiums. And the guaranteed premium over time in offerings are basically 10, 20, and 30 years.
Okay. So they're fixed periods of time.
Right. And when you buy that, obviously, if you bought a contract for, $1 million or $500,000, whatever it is, for a premium of 10 years, the 10-year guaranteed premium, that's what it's guaranteed for. Year 11, look out. That premium is going to skyrocket. I will tell you, I do find it's interesting to hear that a lot of the term shops that advertise on the radio,
yes,
often quote premiums for 10-year term on 40-year-olds. My question always is, what happens when they're 51?
Right.
How does that work? So, yeah, the premium's nice, but the protection just ended, and I still have my kids and wife here, so I'm not. So a lot of times that doesn't make a lot of sense to me. And I will say, those shops, obviously have their place in what goes on, but you don't save any money by excluding an advisor. So I've never been a big fan of that. Mm-hmm. It's like I'm not sure why when I go to the grocery store that I check out my own groceries now, but I don't pay less. So
right.
That's kind of the same option that's given there. But so the term life insurance is basically pure, very simple. It tends to be very appropriate for young couples. It's very inexpensive. Again, we have a young individual who's looking at term life insurance. They're not looking at very high premiums, so it allows them to get a large amount of protection at a very affordable rate.
Okay.
Which is great. And that's what you normally see with young couples. They got a lot going on, a lot of expenses coming their way, but they want to make sure they're covered, and it suits them very well. The next two types of life insurance that come in are considered to be permanent life insurance. So I'm going to start with universal life insurance.
And by permanent, you mean where term is 10, 20, or 30 years, no matter what term period you choose, at the end of that term, you're basically out of insurance. So for some people who say, I want insurance not if I die within a certain period of time, but for when I die, they might have an interest in exploring permanent insurance.
Correct.
Okay.
And it has a number of different, reasons why people would want permanent insurance, but we're not going to go over that today. That'll be for another segment.
Okay.
Well, what I think is valuable for people to understand is what the different types are so that they understand how they work. So we've covered the term life insurance, and now we're on to universal life insurance, which actually is probably the most complicated in terms of all the different things that have gone on with it.
Okay.
Because universal life insurance has changed over time. It started as a basic program where essentially you had your life insurance and they created a savings account. And it really was a savings account. Mm-hmm. It was interest-based, prevailing interest rates that would go on. Now you can imagine that back in the late 70s, early 80s, when interest rates were very, very high, it was attractive to have money in an interest-bearing account. Right. You had CDs paying, 10, 12%. People wanted to get that kind of earnings inside their life insurance contract, and that's where these contracts started to come from.
Okay.
So the basic premise behind a universal life insurance contract of any sort is that you're going to have a premium, and the premium is designed to be level. And inside of what's going on in that contract is that you essentially have a term policy. Now, you don't really have a term policy. You have a universal life policy, but you have the charges for your life insurance are going up a little bit each and every year.
The internal charges, but not your
premiums.
Okay.
So inside there, you have a little, you have the life insurance costs. As you get older, the cost to buy that amount of life insurance is going, is escalating a bit. The simple idea behind it is that when you pay your premium, you have your costs of insurance and other fees that are taken out of it, and then the balance of the premium that you pay is going into the cash value.
Okay.
And that cash value is accumulating over time, and it's accumulating with interest. So the first policies on your cash value began by accumulating interest. So whatever usually, you had a prevailing interest rate, and then whatever that insurance carrier chose to pass on, just like banks do. Not every bank pays the same on CDs. Not every insurance company pays the same interest on the cash value of their life insurance. They're all going to be within the same neighborhood. They're not going to see drastic changes, but there's going to be little differences in terms of what goes on. So over time, that's what goes on. The catch with universal life insurance to keep an eye on is that over time, as those charges grow for the insurance, you have to keep an eye on what's going on there, because if your charge for your insurance is greater than the premium that you chose to pay going in, the policy has only one place to go, well actually two places to go, to make up the difference. They're probably going to pull from your cash value, or you would have the option to pay the higher premium, which most people don't do. Okay. They continue to pay their regular premium, and then they draw from the cash value to make up the difference.
So you're saying if I start, for example, a policy with a scheduled premium of $100 a month, and maybe initially when I'm 25 years old, the mortality cost and fees might be $5 a month, and then $5.10, and it escalates every year I get older, you're saying the more of that premium is being charged for mortality, with the hopes that the cash value account is growing enough to help offset that in my later future years?
Correct. And this is where universal life insurance can become more complicated too. So you can have, with universal life insurance, you can have a level death benefit. So what happens is, upon your death with a level death benefit in universal life insurance, you only get one. You do not get your cash value and the death benefit number. You get one. So what it is with the level death benefit, you're actually only buying life insurance on the difference between your cash value and the death benefit. But even still, as you get older and older and older, even though you're buying less of the life insurance because it's offset by your cash value, the premiums for that can be quite high.
So if I have an example where I have a $100,000 death benefit, and initially I have zero cash value, and then it begins to grow and I have 5,000 or 10,000 cash value. If I have 10,000 cash value, the company's now at risk for only the additional 90,000 because I have a fixed death benefit on that example?
Correct.
And then in later years, by the time I'm 65, I might have a $40,000 cash value. So my mortality cost then is only based on the difference or the excess of this 60,000?
Correct.
But the mortality cost at that 60,000 may far exceed the total of my $100 a month by then, possibly?
Correct.
Okay.
And that's where you just have to keep an eye on universal life insurance. And if you have a universal life insurance policy, if you've had one for a long time, I strongly encourage people to see their advisor and have them take an analytical look at it.
You know what we call that, folks? We propose that everyone that has a universal life insurance policy does what we call a life insurance policy audit. And what that means is, well, you could explain what that really means. It's not only if you have universal life. It's if you have term life. It's if you have any form of life insurance that you've had for a period of time. We recommend as financial planners that you do a life insurance policy audit or a life insurance planning audit. And you want to explain some of that?
Yeah, well, the audit of a life insurance contract is to explore and double check its functionality. So to our example, when we were talking about universal life insurance, there are a number of different factors that affect that. There are the internal charges that are associated with that. There are the interest rates of where they've been, where they're headed, different ideas along those lines. So that's the functionality that you want to check on a universal life insurance. Across the board with all forms of life insurance, you want to make sure that your beneficiary designations are correct.
Good point.
So a lot of times people don't realize it, but in an extreme example, you could be in a second marriage and you might find out that the first wife is the beneficiary.
Right.
And the beneficiary designation of a life insurance contract, or for that matter, anything that you use a beneficiary on, will supersede anything you write in a will. The will never be seen. So if you have a beneficiary designation on a life insurance policy, any other accounts you have, those are basically seen as you've already said where you want it to go. Your will could say anything it wants, it won't matter.
So even though you have a will that says the life insurance proceeds go to spouse number 2, it's a contract beneficiary that the company has to honor what's written into the contract, which a will cannot trump.
Correct. The will won't even be looked at
By the life insurance carrier.
And the only way you can
or anything with a beneficiary designation.
Correct. Which is nice because beneficiary designations avoid probate, because probate is all about figuring out who gets what. This is telling everybody who got what.
Okay.
If you do want your life insurance policies, which I don't recommend, to go through your will, you can just name that your beneficiary just becomes your estate.
And I'll caution everyone listening or watching this show, do not do that. And then if you think you should do that, you get to your attorney first. Because even us as financial planners and life insurance experts, the minute we start telling you how to distinguish how to describe your beneficiary designations, that is in essence giving legal advice inappropriately, because we are not trained to give legal advice and we are not trained to give beneficiary advice. So you have to see your attorney, you have to get the legal advice on who should be named as your beneficiaries on these contracts, and then bring that information to us upon the recommendation of your attorney, and we will follow that legal advice, but we will not give that legal advice.
Correct. So, and what you're doing in the part of the audit is just to make sure that when you look at your beneficiaries, that it's the way you want it to be.
Right.
That's the bottom line on that. So those are the couple of big areas. Ownership can come into play sometimes. Sometimes people aren't aware of who owns what and how that works, and that should be examined too. So we've talked about, with the three types, we have the term life insurance, which is very simple, straightforward life insurance. We have the universal life insurance, which now has more moving parts. I will say that universal life insurance branched out from offering just the interest sensitive, which is just the savings account with the interest. As you can imagine, those fell out of favor when interest rates plummeted. So all those expenses and different when the interest rates came way down, what people thought their policies would do, they would no longer do. So you can imagine if you're looking at something that's based on getting 10% and now it's getting 4%, a lot changed.
Are you finding problems with some of the older universal life contracts?
We do see problems with some of them where they're at a point where they're going to expire. In other words,
run out.
Yes. Well, what happens in that case is the charges are eating all of the cash value. So you can have individuals who could end up with nothing, no cash value, no life insurance.
So people bought what we called permanent life insurance, and they're running into a situation, some of them, where they're going to be running out of life insurance, and here they're 70 years old and now can no longer qualify for any replacement?
Correct.
Is that happening?
That is happening. So that's why...
That's scary.
And that's why you really want to take a look at what these are. So you just want to make sure that you have somebody do a review to do the math on it. The statements, that information is in the statements that the individuals are receiving. But like a lot of stuff, it can be very confusing to read.
Are people aware that's happening?
Some are, many are not.
Wow. So what do?
See an advisor.
And get a life insurance policy audit.
Yep.
Run the report, we rerun them and get it analyzed, just like a doctor checkup.
Yep, absolutely.
Are you sick? Is your life insurance policy sick and you don't know it?
So those policies with the interest sensitive fell out of favor. The next thing that came along was a variable policy where they started putting those into sub-accounts, basically investing the cash into the market. Those have gone their course, and those ran into their own issues, as the market will too. But it's the same basic premise. It's the same chassis. It's just what's crediting to the cash value that's different. The newest one on the block is the indexed universal life insurance. And those are, again, it's just another way of doing accrediting on the interest in terms of what's going on. It's the same chassis. And they all need to be watched. There's only one type of universal life insurance policy that you don't need to watch too closely. and that's what's called guaranteed universal life insurance. Those contracts are much more like term insurance. As a matter of fact, I kid and I call them, it's term till you die. Because there's two things that are guaranteed on those contracts, your premium and your death benefit. That's it.
Are they guaranteed to a certain point, or how do they do that?
For as long as you want, to up to age 121. But yes, you can.
Okay, well, we're pretty safe, I hope.
You can have them, but there are ones that could be only guaranteed to 95 if you wanted that, or 100, because the premium's going to change.
Okay.
But everything, where they say guarantee, they take guarantee very seriously. So that's how that gets done. The third type of life insurance is whole life insurance. And whole life insurance is actually a bit more simple than universal life insurance, but it's also permanent, but it's chock full of guarantees. So a whole life insurance contract has underlying guarantees. It has guaranteed premium, it has guaranteed death benefit, and if you remember me talking about the mortality charges, the cost for the actual insurance,
yes,
that's guaranteed too. So that's guaranteed in flat.
Wow.
So what you have when you have all those guarantees in there is you have something that's a little bit more stable.
And predictable.
Much more predictable. What happens there with those contracts is they're either going to be augmented above and beyond their guarantees, either by dividends, if it's a mutual company, and that basically means is that the company is owned by the policyholders.
Okay.
Very oftentimes, you will see the name mutual within the company, and it'll give you a first indication that it's a mutual company.
Okay.
Or it could be interest. They're using an interest-sensitive whole life insurance. And really all that means is the chassis, in other words, how the contract is built with all those guarantees is there, but the way the cash value is growing is going to be based on interest rates.
So if we look at a situation where whole life has the guaranteed cash value, guaranteed death benefit, guaranteed premiums, do we have guaranteed dividends?
No. You do not have guaranteed dividends. You do not have guaranteed interest rates either. Now, what you do have, and it can be confusing, but need not be confused too terribly much, you do have guaranteed cash value.
Okay.
So with a whole life insurance, if you look at everything guaranteed with whole life insurance, what you will find is that the way it works is that depending upon the carrier, but most carriers have their policies all true up at age 100. And what that means is they guarantee that the cash value will be the same as the death benefit at age 100.
Oh, so that's pretty strong.
Yeah.
Yeah.
So it is guaranteed. And there is an underlying interest rate in there. It varies from carrier to carrier.
Okay.
And some carriers, have their guarantees true up at 100. Some older contracts are 95. Some newer contracts are 110.
Okay.
So you won't see a lot of carriers that have actually, ever paid the guarantee. It's always been augmented. But it's nice to know you have those underlying guarantees that are there.
Okay.
So those are the three basic types of coverage. How you use those and where they make sense, I think we're going to break down at a later time so that we can take it, one step at a time on those. But the good thing to remember is that there are basically three types of life insurance with a bunch of different names for all of them.
Yeah, that's interesting. I've never heard it explained that way, and it does at least help categorize for the three different groups. Well, again, folks, we're out of time, but I appreciate your tuning into another edition of All Things Financial. We'll be back for the next couple of weeks with Ian George. Thank you so much for offering
My
to
pleasure.
be able to come in for that. We'll see you again next week, and thanks for tuning in.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.